Investing for Growth: How to Make Money by Only Buying the Best Companies in the World by Terry Smith. There's a photograph from 1971 that captures something essential about the human spirit. In a boxing ring at Madison Square Garden, two giants are locked in combat. One is Muhammad Ali, graceful, poetic, the symbol of rebellion. The other is Smokin', Joe Frazier. Frazier was everything Ali wasn't. Relentless, a force of nature who kept pushing forward, absorbing punishment, head down, always hunting. Powered by a left hook that hit like thunder. That night, in what became known as the fight of the century, Frazier did the unthinkable. In the 15th round, he landed that left hook and sent Ali to the canvas for the first time in his professional career. Frazier won. But here's what made Joe Frazier truly great. It wasn't just his own strength. It was his connection to the men he fought. He was defined by Ali and by another giant, George Foreman. As our guide today, Terry Smith, would later write, "We would all do well to remember that we are defined by those with whom we compete." It might seem odd to start a conversation about investing with a story about boxing, but the world of finance, like the boxing ring, is packed with contenders. It's a world of fierce competition, clever opponents, and powerful forces trying to knock you off your feet. For over 4 decades, Terry Smith has been the financial world's Joe Frazier, relentlessly moving forward, armed with a simple but devastatingly effective weapon: common sense. He's been called Britain's Buffett, a plain-spoken rebel who took on the entire fund management industry and won. His book, Investing for Growth, isn't your typical finance book. It's an anthology, a collection of his sharpest articles and letters to investors, written over a decade, where he put his ideas to the ultimate test. It sold millions, not because it offered complex formulas or get-rich-quick schemes, but because it revealed a truth so simple, so powerful, that the so-called experts had spent their careers burying it under layers of jargon and fees. Today, we're stepping into the ring with Terry Smith. We're going to strip away the noise, the complexity, and the myths that hold so many people back from building real wealth. By the end of our journey, you'll understand the 3 simple steps to financial success. A 3-step mantra that, if you truly take it to heart, can not only make you a better investor, but fundamentally change how you see the world of money. This isn't about learning a few stock tips. This is about learning a philosophy you can carry with you for the rest of your life. So let's begin. Part 1. The Broken Machine: Why Almost Everyone Gets Investing Wrong. Before we can understand how to build wealth, we have to understand why so many people fail. Turn on the news or read the financial papers, and you're bombarded with constant noise. Experts predicting what the economy will do next, whether interest rates will rise or fall, what'll happen with China, with oil prices, with the next election. It all sounds incredibly important. It feels like if you could just figure out the answers, you'd unlock the market's secrets. Terry Smith has a simple response to all of this: it's useless. He quotes the economist J.K. Galbraith, who once said, "The only function of economic forecasting is to make astrology look respectable." Think about it. In the last decade alone, how many major events did the world's top forecasters get completely wrong? They told us Brexit wouldn't happen. They told us Donald Trump wouldn't become president. They even told us a Brexit vote would trigger an immediate recession. None of it happened. The problem, as Smith points out, is that many forecasters have stopped trying to predict events and started trying to influence them. They surround themselves with people who think the same way, creating an echo chamber where their beliefs get amplified, and they disregard anything that doesn't fit their worldview. It's not an approach designed to find truth. It's designed to confirm bias. But even if you could predict the future with perfect accuracy, you'd still face another, bigger problem. The market is what's called a quote-quote second-order system. What does that mean? It means knowing what will happen isn't enough. You also have to know what everyone else thinks will happen, so you can predict how they'll react. You have to be right about the event, right about the timing, right about the market's expectations, and right about the market's reaction. The odds of getting all that right consistently are basically zero. So Terry Smith says, stop trying. He places himself firmly in the camp of forecasters who know they don't know, which gives him a massive advantage over those who don't know they don't know. This obsession with the unpredictable is just the first flaw in the financial machine. The second is the machine itself, the fund management industry. Imagine you walk into a store to buy something. The salesperson shows you two options. One is simple, cheap, and does exactly what it promises. The other is incredibly complex, wrapped in fancy packaging, comes with a huge fee, and most of the time doesn't work as well as the simple one. Which one do you think the salesperson will push? The expensive one, of course. That's how they make their money. Welcome to the world of fund management. For years, the industry has sold a myth that you need a highly paid, brilliant, active fund manager to navigate the treacherous waters of the stock market. These managers, we're told, use their expertise to pick winning stocks and avoid losers. The standard fee structure for this expertise, especially in hedge funds, was famously known as 2 and 20. They'd charge you a 2% fee on all your money every single year, plus take 20% of any profits you made. Sounds like a fair deal. They only make big money if you do, right? Wrong. Terry Smith calls this structure unsupportable, and he demonstrates why with a stunningly simple calculation. He asks us to imagine that the greatest investor of all time, Warren Buffett, had decided to run his company, Berkshire Hathaway, as a hedge fund charging 2 and 20. From 1965 to 2009, Buffett delivered legendary performance, turning a $1,000 investment into $4.3 million. An incredible result, but if he'd charged that standard hedge fund fee, of that $4.3 million, a staggering $4 million would have gone to him as the manager. You, the investor who put up all the capital and took all the risk, would have been left with just $300,000. And that's if your manager performed as well as Warren Buffett. As Smith Riley notes, believe me, he or she won't. Performance fees, he argues, simply don't work for the investor. They extract too much of the return and, even more dangerously, encourage reckless behavior. They create a heads I win, tails you lose scenario, where managers are incentivized to take huge risks with your money. If the bet pays off, they take a massive cut. If it fails, well, it was your money to begin with. But it's not just the fees you can see. Hidden costs are everywhere. The average fund manager in the UK, according to research, turns over their entire portfolio by about 80% every year. Think about that. They're buying and selling almost everything they own, every single year. This constant churning racks up costs, broker commissions, the spread between buying and selling prices, and taxes. These costs aren't listed in the shiny brochure. They're deducted directly from your returns. As Buffett's partner, Charlie Munger, wisely observed, the stock market is designed to transfer money from the active to the patient. The industry has built a machine that thrives on activity, on complexity, and on convincing you that you need them. Nowhere is this more apparent than in the rise of one of the industry's favorite products, the exchange-traded fund, or ETF. On the surface, ETFs seem like a great idea. They're often seen as simple, low-cost index funds you can trade like a stock. And many investors, fleeing the high fees and poor performance of active managers, have poured trillions of dollars into them. But Terry Smith sounded the alarm early, warning that ETFs were far more dangerous than people realized. He compares the situation to a car dealership. You go in asking for a simple, reliable family car, and the dealer sells you what looks like one. But under the hood, it's a complex, high-performance engine that you don't understand, and it's prone to blowing up. His first warning was about synthetic ETFs. You see, many investors assume that if you buy an ETF tracking, say the top 500 U.S. companies, the fund actually goes out and buys shares in all those companies. But with a synthetic ETF, it doesn't. Instead, it enters into a contract, called a swap, with a counterparty, usually a big investment bank. That bank promises to pay the ETF the return of the index. This should immediately set off alarm bells. As Smith points out, anyone who lived through the 2008 financial crisis should be deeply suspicious of words like derivative, swap, and counterparty risk. What happens if that big investment bank, the one promising to pay you, goes bust? The collapse of Lehman Brothers showed us this isn't a theoretical risk. It's very real. Your investment isn't backed by real shares, but by a promise from an institution that could fail. Then there are the leveraged and inverse ETFs, which he describes as day trading tools often misused by regular investors. These are funds designed to multiply the daily return of an index, or to bet against it. A 2x leveraged ETF, for example, promises to give you twice the daily return of the market. But here's the deadly catch Smith highlights. The returns are compounded daily. This creates bizarre and painful outcomes in a volatile market. He provides a simple table to illustrate. Imagine a market that goes up 25% one day, then down 28% the next, then up 14% on the third day. Over those 3 days, the index itself is up 3%. You might think your 2x leveraged ETF would be up around 6%, but because of daily compounding, it would actually be down 15%. You can be right about the market's direction over a week or a month and still lose a shocking amount of money. An inverse ETF, which bets against the market, can lose money even if the market goes down over a period. It's a trap, and Smith believes a huge proportion of investors have no idea these products can behave in such perverse ways. He paints a picture of an industry built on flawed incentives, hidden costs, and dangerously complex products. It's a machine designed to enrich the operators, not the investors. And caught in the middle of this machine is the average person, who makes things even worse through their own predictable, emotional mistakes. This brings us to the final and perhaps most painful part of the problem, us. We are our own worst enemies. The legendary American sprinter Michael Johnson once said, "The only one who can beat me is me." He meant it as a statement of confidence, but it reveals a deeper truth. So often we're defeated not by our opponents, but by our own psychology. This is especially true in investing. There's a classic goal in investing: buy low, sell high. It's called market timing. It sounds so simple, so logical. Who wouldn't want to get into the market at the bottom and sell at the top? The trouble is, all the evidence shows we do the exact opposite. Smith presents a chart that's both comical and tragic. It tracks the flow of money into and out of equity funds against stock market performance. And what it shows is a perfect pattern of terrible decisions. Money pours into funds after the market has gone up, as people chase past performance, desperate not to miss out. And money floods out of funds after the market has crashed, as people panic and sell at the bottom. We are, as a group, hardwired to buy high and sell low. We feel comforted by the crowd, like lemmings heading for a cliff, and we can't bear the lonely feeling of being a contrarian, buying when everyone else is terrified. And it's not just small amateur investors. Professionals are just as bad. Data shows that pension fund trustees, people managing billions of dollars, consistently fire fund managers after a period of poor performance and hire managers who've had a hot streak, often just as their fortunes are about to reverse. The damage this does to your returns is catastrophic. Smith highlights a study showing that if you'd invested $10,000 in the S&P 500 index for the decade, from 1994 to 2004, you would have ended up with over $31,000. But if you'd tried to time the market and just missed the 10 best days, only 1 day per year on average, your final amount would have been cut to less than $20,000. Miss the best 30 days, and you would have actually lost money. The vast majority of the market's long-term gains come in short, explosive bursts. If you're not in the market when they happen, you miss out. As Smith bluntly puts it, there are only 2 types of investors: those who know they can't make money from market timing, and those who don't know they can't. It's far safer, and far more profitable to be in the first camp. So this is the world Terry Smith saw. A world of flawed advice, crippling fees, dangerous products, and self-defeating human emotions. It's a broken machine. And faced with this reality, he came to a simple, radical conclusion. If you want to win, you have to play a different game. You have to step outside the machine entirely and follow a different set of rules. 3 rules, to be exact. And the first one is the most important of all. Part 2. The First Commandment: Buy good companies. The foundation of Terry Smith's entire philosophy, the central pillar on which everything else rests, is this: only buy shares in good companies. It sounds blindingly obvious, doesn't it? Who would set out to buy shares in bad companies? And yet, as Smith points out with constant amazement, the vast majority of the investment world doesn't seem to prioritize this at all. They're obsessed with everything else: economic forecasts, what central banks are doing, regional allocations, and above all, whether a stock is cheap. Smith argues this is a profound mistake. He believes most fund managers invest in poor or average companies for one main reason: they hope something will change. They think a new management team will turn things around, or that an economic upswing will lift the company's fortunes, or that it'll get taken over. They're betting on transformation, but this is a dangerous game. As Smith notes, while they're waiting for their corporate frogs to turn into princes, those frogs are steadily destroying value. Time is the enemy of a mediocre business. But for a wonderful business, time is your greatest friend. When you own a truly great company, you can be confident that its intrinsic value is growing almost every single day. You don't need to hope for a lucky break. You just need to let the powerful engine of the business do its work. So what exactly is a good company in Terry Smith's eyes? He has a very clear, data-driven definition, and it revolves around one key metric that he believes is the ultimate test of a business. It's a concept called return on capital employed, or ROCE. Now that might sound a little technical, but the idea is incredibly simple. Imagine you own a small bakery. The capital employed is everything you've invested to get it running: the oven, the mixing bowls, the shop front, the cash in the register. Let's say that's $100,000. At the end of the year, after all your costs, you've made a profit of $20,000. Your return on capital employed is 20%. For every dollar you put into the business, it generated 20 cents of profit. This, Smith argues, is the primary test of managerial performance. It tells you how effective a company is at turning its assets into profits. A company that can consistently generate a high ROCE, say 20 or 30%, is a value-creating machine. A company with a low ROCE, say 5%, is destroying value because that capital could be earning a better return almost anywhere else. To see this principle in action, we only need to look at one of the most famous business flameouts in recent British history: the collapse of Tesco, the supermarket giant. For years, Tesco was the darling of the stock market. Analysts loved it, investors flocked to it, and even the great Warren Buffett owned a huge stake. People constantly asked Terry Smith why he didn't own shares in this UK champion. His answer was simple. He'd looked at the numbers, and they told a terrifying story that almost everyone else was ignoring. He presents a chart that should be studied by every investor. It shows 2 lines during the celebrated leadership of its CEO, Sir Terry Leahy, from 1998 to 2011. The first line, tracking earnings per share, is exactly what investors wanted to see. It's a beautiful, steady climb from bottom left to top right. This number is what most analysts focus on. It seemed to prove the company was a roaring success. But the second line on the chart shows the return on capital employed. And that line tells the opposite story. It's a steady, relentless decline, falling from a healthy 19% down to a mediocre 10%. What did this mean? It meant that to generate that beautiful, rising earnings line, Tesco's management was pouring more and more capital into the business: new stores, international expansion, at ever lower rates of return. They were growing, but they were growing by becoming a worse business. They were destroying value even as their profits went up. Smith compares the market's focus on the rising EPS line to the hypnotic gaze of Ka, the snake from the Jungle Book. Investors were mesmerized, and they missed the clear and present danger right in front of them. Even worse, during this period, Tesco changed its definition of ROCE 8 times, a classic sign that a company is trying to hide something. The eventual collapse, the profit warnings, and the accounting scandal didn't come out of nowhere. The warning signs had been flashing in bright red for over a decade. Now, let's contrast that with a company everyone thought was finished, Microsoft. Back around 2011, when Smith started buying shares, conventional wisdom was that Microsoft was a dinosaur. It had missed the boat on mobile phones, it was losing the search engine war to Google, and it was tied to the declining PC market. The commentary was brutal. People demanded to know why Smith would invest in a dying company. One investor even called him, worried about a single bad quarter's results, and warned he'd face questions at the next annual meeting. But Smith ignored the noise and did what he always does. He looked at the facts. And the facts told a very different story. While the world focused on the consumer-facing products they knew, like Windows, they were missing where Microsoft made its real money. Its largest and most profitable division was its servers and tools business, selling essential software to IT professionals and developers around the world. This was the engine of the company, and it was humming. The financial performance was stunning. From 2006 to 2012, a period that included the Great Financial Crisis, revenues grew by 66%. Operating cash flow grew by 119%. These were the numbers of a thriving business, not a dying one. And yet, because of the negative narrative, you could buy its shares at an incredibly cheap valuation, with a free cash flow yield of over 8% and a price-to-earnings ratio of just 12. The lesson is profound. The market is often driven by stories, by narratives, by emotion. The story about Tesco was one of unstoppable growth. The story about Microsoft was one of inevitable decline. Both stories were wrong. The truth was in the numbers, available for anyone willing to look. Smith simply chose to believe the numbers over the narrative. The stock went on to nearly double in price soon after. So a good company is one that generates a high return on capital. But there are other characteristics Smith looks for. He loves businesses that make their money from a huge number of small, everyday, repeatable transactions. Think about things like toothpaste, pet food, soap, or soft drinks. These are consumer non-durables. You buy them, you use them up, and you have to buy them again. No one needs a bank loan to buy a tube of Colgate. You don't haggle with the cashier over the price. And brand loyalty is incredibly powerful. Research even shows that in hard times, people are more likely to cut back on food for themselves than on food for their pets. These boring businesses are often the most powerful cash-generating machines in the world. They have intangible assets, brands, patents, distribution networks that create what Warren Buffett calls a moat, a defensive barrier that keeps competitors at bay. Think of Colgate-Palmolive, which has 45% of the global market for toothpaste. Or Nestle, the world's largest food company, which has been in business for nearly 150 years and has only ever recorded one annual loss. These are the businesses that have already won. Smith isn't trying to predict the future. He's trying to identify the companies whose past success is so dominant that their future is as close to a certainty as you can get in the world of investment. This is the first and most important step. Find these wonderful companies. But that's only half the battle, because even a wonderful company can be a bad investment if you make one critical mistake. Part 3. The Second Commandment. Don't overpay. Once you've identified a truly great company, the next question is obvious. What price should you pay for it? This brings us to one of the oldest and most contentious debates in investing, the battle between value and growth. In one corner, you have the value investors. Their philosophy, famously established by Benjamin Graham, is to buy stocks for less than their intrinsic worth. In its modern, simplified form, this is often morphed into just buying stocks that look cheap on paper, those with low price-to-earnings ratios or low price-to-book values. In the other corner are the growth investors who focus on companies rapidly expanding their revenues and profits, even if their stocks look expensive by traditional measures. Terry Smith argues this is a false choice. To quote Warren Buffett, who evolved from a pure value investor to what he is today, "Growth and value are joined at the hip." Growth is a component of a company's value. It can enhance it or diminish it. The real question isn't whether a stock is value or growth, but whether the price you're paying is fair relative to the quality of the business you're getting. Smith is deeply skeptical of the simplistic approach of buying stocks just because they look cheap. As he says, lowly rated does not equal good value. A stock might have a low valuation, but if the business itself is terrible, its intrinsic value might be even lower. Buying such a stock isn't a recipe for success. It's a trap. He demonstrates this with a powerful table in his book. He takes a group of classic value stocks from 2015, companies like Exxon, General Electric, and HSBC, which all had low PE ratios at the time. Then he looks at what happened to their earnings over the next 5 years. In almost every case, the earnings collapsed. Exxon's earnings per share fell by 78%. GE's went from a profit to a loss. HSBC's did the same. The market was right to give them a low valuation. If anything, it wasn't low enough. These stocks looked cheap, but they were value traps. The businesses were deteriorating faster than their share prices were falling. Now contrast that with a group of growth stocks from the same period that looked terrifyingly expensive. Adobe, with a PE of 136. Amazon, which was losing money. Facebook, with a PE over 70. A traditional value investor wouldn't have touched them. But what happened to their businesses? Adobe's earnings grew by over 1,300%. Amazon became massively profitable. Facebook's earnings grew by 645%. Looking back, it's clear their high ratings were more than justified by the phenomenal growth that was to come. Their businesses were growing so fast that they quickly grew into their valuations, and then far beyond them. This brings us to the core of Smith's argument on valuation, the almost magical power of compounding. Warren Buffett has called it the eighth wonder of the world, and Smith believes understanding its effects is essential to successful investing. He asks a simple question. If you have an investment that compounds at 10% per year, how long does it take to double your money? The answer isn't 10 years. Because of compounding, it's only 7. A 7% return will double your money in 10 years. Now, consider this. What's the difference between a 10% compound return and a 12.5% compound return over 30 years? It sounds like a small difference, just 2.5 percentage points. But the answer is staggering. That extra 2.5% per year will double your final capital. A small, consistent edge in the rate of return, sustained over a long period, leads to an exponentially different outcome. This is the mathematical secret behind why it's safe to pay up for quality. A truly wonderful company, one with a high and sustainable return on capital employed, is a compounding machine. Its intrinsic value is growing at a much faster rate than an average company, and that superior growth rate can justify a valuation that might seem eye-wateringly high to the untrained eye. To prove this, Smith performs a fascinating historical experiment. He looks back to the year 1973 and analyzes a group of high-quality consumer goods companies like L'Oreal, Colgate, and Coca-Cola. He asks, what price-to-earnings ratio could you have paid for these stocks back in 1973 and still have beaten the return of the overall market index over the next 46 years? The results are mind-blowing. The market index at the time had a PE ratio of around 19, but for Coca-Cola, you could have paid a PE of 63 and still beaten the market. For Colgate, you could have paid a PE of 126. And for the cosmetics giant L'Oreal, you could have paid an astronomical PE ratio of 281, and you still would have come out ahead. How is this possible? Because these companies were such powerful compounders. Their ability to consistently grow their earnings and reinvest them at high rates of return created so much value over the long run that even a ridiculously high starting valuation was eventually overwhelmed. The quality of the business was far more important than the initial price tag. This doesn't mean price is irrelevant. Smith is clear on this. His second rule is don't overpay. He's not advocating buying stocks at any price. His preferred valuation metric isn't the P/E ratio, but something called the free cash flow yield. Think of it like this. If you bought an entire company for its total market price, the FCF yield tells you what percentage of your purchase price you'd get back in cash in the first year. A company with a market value of $100 billion that generates $5 billion in free cash flow has a 5% FCF yield. Smith's rule of thumb is to only buy companies when their FCF yield is attractive relative to the yield on long-term government bonds. If you can buy a great, growing company with a cash yield that's higher than the risk-free rate on a bond, you've likely found a good investment. The bond's coupon will never grow, but the company's cash flow can, and likely will. This focus on high-quality compounders is often criticized, especially when interest rates are expected to rise. Commentators label these stocks bond proxies, safe, predictable investments that people have flocked to in a low-yield world. The theory goes that when interest rates rise, bond prices will fall, and these bond proxy stocks will fall with them. Smith has been hearing this warning for years, and while he acknowledges the logic, he pushes back with a simple question. If you sell these wonderful companies, where are you going to put your money? Into bonds, which are guaranteed to lose value if rates rise. Into cheap, cyclical stocks, which will get crushed if rising rates cause an economic slowdown. The alternatives are often far more dangerous. He brings it all back to the wisdom of Charlie Munger. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If you plan to be an investor for decades, the single most important factor is the underlying quality and compounding power of the business. Everything else is just noise. This leads us directly to the third and final step of his philosophy. It's the step that requires the most discipline, the most patience, and for many, is the hardest one of all. Part 4, the third commandment, do nothing. Once you've bought shares in a portfolio of wonderful companies at fair prices, what do you do next? Terry Smith's answer is radical in its simplicity. You do nothing. In an industry that thrives on action, on trading, on constantly moving things around, this is the ultimate act of rebellion. Fund managers often feel they need to be constantly active to justify their fees. But Smith argues this activity is precisely what destroys value. Every trade has a cost: commissions, taxes, and the bid-offer spread. And as we've already seen, our attempts to time the market are almost always wrong. Therefore, the logical conclusion is we should deal as infrequently as possible. This philosophy of masterly inactivity is best explained through one of Smith's favorite analogies, the Tour de France. The Tour de France is the world's greatest cycling race, run over 21 stages in 23 days. There are 3 different types of stages. There are the flat stages, where cyclists ride together in a tight pack called the peloton, and it's all about teamwork and explosive speed at the end. There are the time trials, where each rider competes alone against the clock, a pure test of individual power and aerodynamics. And then there are the brutal mountain stages, lung-busting climbs that test endurance to its absolute limit. Here's the crucial lesson. In the 100-year history of the race, no single rider has ever won every single stage, and no one ever will. The physique required to be a sprinter is completely different from that of a mountain climber. The way to win the entire tour isn't to be the best at everything, but to be excellent at one discipline, good enough at the others, and to have the patience and endurance to stick with it for 3 long weeks. In fact, the race has twice been won by a rider who didn't win a single stage. Investing, Smith says, is exactly the same. Searching for a fund manager or a strategy that can outperform the market in every single quarter, in every type of market condition, is as pointless as looking for a cyclist who can win both the sprints and the mountain climbs. It doesn't exist. Yet this is precisely what so many investors do. They check their portfolio's performance every quarter or even every month, and if a fund has a bad period, they get nervous and switch to whatever's been performing well recently. This is like a cycling team manager firing his best time trialist because he had a bad day in the mountains, only to watch him win the next time trial for a rival team. The fundsmith strategy is designed to perform well in bear markets and may struggle to keep pace in raging bull markets, much like a climber excels in the mountains but might get left behind in a flat sprint. The goal isn't to win every stage. The goal is to win the tour. It's a test of endurance, and the winner is the investor who finds a good strategy and has the discipline to stick with it over the full economic cycle. This means you have to learn to run your winners. Too often, investors have a good stock that goes up, and their first instinct is to take a profit. Smith argues this is usually a mistake. If an investment has a profit, it might be a sign you own a share in a wonderful business that's worth holding on to for a very long time. Conversely, we're all prone to holding on to our losers, hoping they'll get back to the price we paid for them. This is the opposite of what a good gardener does. A gardener nurtures the flowers and pulls up the weeds, not the other way around. Smith's best-performing stock since his fund's inception was Domino's Pizza, which returned over 600%. It's a perfect example of his philosophy. It's not an obscure, esoteric company no one had ever heard of. It's an obvious business. It's a franchisor, which is a fantastic business model because the franchisees put up most of the capital. The parent company just collects a royalty on sales generated by other people's money, an incredibly high-return business. And most importantly, they focused relentlessly on what mattered, the food. In 2009, they famously launched an advertising campaign admitting their pizza wasn't very good, publishing customer critiques like, "The crust tastes like cardboard. You only do something that honest if you're serious about changing." And they did. The shares went from $8.50 to $68. Holding on to a stock like that, through all the ups and downs, requires a different mindset. It requires you to bet on the business, not the stock price. To explain this, Smith tells the story of Alex Bird, a legendary professional gambler in the UK. Bird made his fortune by betting on horse races after they had finished. In his day, photo finishes weren't digital. It took several minutes to develop the film to see which horse had won. During this time, bookmakers would continue to take bets on the outcome. Bird realized they were breaking a cardinal rule: never make odds on an event that's already happened. He developed a simple technique using parallax vision, standing right by the finish line, which allowed him to know with certainty which horse had won before the official result was announced. He would then calmly place his bets with the unsuspecting bookies. He reportedly made 500 consecutive successful bets. This, Smith says, is what his strategy is all about. He's not trying to predict which horse will win the race. He's trying to emulate Alex Bird. He waits until he knows which companies have already won: the Nestle's, the Colgates, the Microsofts. And then he waits for the market, in a moment of panic or short-sightedness, to offer him foolish odds against them. He's not speculating. He's betting on a near certainty. And once you've made that bet, you have to have the fortitude to ignore the noise. Ignore the commentators on TV telling you the market's about to crash. Ignore the articles telling you your quality stocks are too expensive. Ignore the temptation to constantly check your portfolio. As his 10th golden rule of investment states, if you don't like what's happening to your shares, switch off the screen. The entire philosophy can be distilled into that simple 3-part mantra. It's a cycle that repeats itself. Buy good companies. Find those rare, wonderful businesses that are compounding machines. Don't overpay. Have the discipline to wait for a fair price, understanding that the quality of the business is what matters most in the long run. And then, do nothing. Let the power of compounding do the heavy lifting for you. Have the patience of a marathon runner, not the frantic energy of a sprinter. Let time be your friend. It's a philosophy that's simple, but not easy. It requires discipline, patience, and a deep-seated refusal to get caught up in the madness of the crowd. But as Terry Smith has demonstrated over a decade of spectacular results, it's a philosophy that works. When you finish a book like Investing for Growth, you're left with a feeling that's both liberating and a little bit unsettling. It's liberating because Terry Smith has given us a map to a destination we all want to reach, financial security, and that map is incredibly simple. It doesn't require a PhD in economics or a supercomputer in your basement. It requires just 3 common-sense steps. But it's unsettling for the same reason. If it's really that simple, why isn't everyone doing it? Why does the entire financial industry seem built on the exact opposite principles? On complexity, on frantic activity, on short-term speculation? I think the answer lies in a fundamental truth about human nature. We're drawn to complexity because we believe it signals sophistication. We're drawn to action because it makes us feel in control, and we're drawn to the crowd because it makes us feel safe. Terry Smith's philosophy requires us to fight against all those instincts. It requires us to embrace simplicity, to practice patience, and to have the courage to stand alone. The most powerful lesson I take from this collection of writings is the profound difference between a business and a stock price. The stock market is a chaotic, emotional, often irrational place. It's a whirlwind of fear and greed, of headlines and rumors. But a business, a great business, is something else entirely. A great business is an engine. It takes in capital, applies human ingenuity, and produces something of value for its customers, and in doing so, generates profits and cash for its owners. Day after day, year after year, the stock price will dance and flicker, but the engine of the business just keeps running. The secret Terry Smith has unlocked is to stop watching the flickering lights of the stock market and focus entirely on the quality of the engine. Is it efficient? Is it durable? Can it run for a very, very long time without breaking down? If you can get that part right, the stock price will eventually take care of itself. So how can you apply this wisdom in your own life, starting today? First, take a look at any investments you might have, or that your family might have. Ask a simple question for each one. Is this a truly great company? Do I understand how it makes money? Does it have a high return on capital? Would I be happy to own this business for the next 10, 20, or even 30 years? If the answer is no, ask yourself why you own it. Are you betting on a lucky break? Are you hoping a frog turns into a prince? Second, become ruthlessly aware of costs. Go and find out what fees you're paying for any investment product you own. Not just the headline fee, but the total cost, including the hidden costs of trading. Costs are like a leak in a bucket. It might seem small, but over a lifetime of saving, it can drain away a shocking amount of your wealth. Minimizing costs is one of the few things in investing you have complete control over. And finally, practice the art of doing nothing. This might be the hardest part. The world will scream at you to do something. To sell during a crash, to buy into the latest hot trend, to constantly tinker and adjust. Have the discipline to resist. Make a commitment to check your investments less frequently. Once a year is plenty. Trust in the power of the great businesses you own and let them do the work for you. That was a summary of Investing for Growth by Terry Smith. We've journeyed through the core of his philosophy today, but I have to be honest with you. A summary can only ever show you the map. The real adventure begins when you decide to take the journey yourself. There's a certain magic that happens when you read a book like this. A specific story, a particular phrase that connects with you in a way you didn't see coming. This summary is your compass, designed to help you decide if this is a path worth walking. If anything we've talked about has sparked something in you, I truly encourage you to pick up a copy. Reading it isn't just about learning. It's an experience that can genuinely rewire how you think about building wealth for a lifetime. The link to the book is in the description below. Also, if this journey through Terry Smith's wisdom has been valuable to you, please take a moment to click that like button and subscribe to the channel. That way, you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's continue to learn and grow together.